Whether you're into FIRE, that's financial independence, retire early, or you need to tap your traditional IRA before the official retirement age of 59 and a half, it typically triggers a 10% early withdrawal penalty on top of ordinary income taxes. That's a big bite out of your wealth that you'd probably like to avoid. That's what today's topic is about. You might be surprised to learn that the IRS allows you to skip that hefty 10% early withdrawal penalty when you set up a workaround known as a 72T plan. This podcast will review how 72T distributions work, their pros and cons, and when it might be a good financial move. Welcome back. This is episode 983 of Money Girl. I really appreciate you being with me and downloading the show. If you're new, I'm Laura Adams, an award-winning author, on-camera spokesperson, money speaker, and founder of The Money Stack. That's my Substack newsletter. Free subscribers automatically receive my Money Success Toolkit, which includes the exact templates I use to manage my money. You can learn more, ask money questions, and of course, sign up for The Money Stack for free at lauradadams.com. Again, that's lauradadams.com. I also have a voicemail system where you can leave a message with your question or comment. Just call 302-364-0308. And you can also find that information in the show notes. I'd love to feature your question on Finance Friday. That's our weekly Q&A bonus edition of the show. All right, let's talk about 72T payment plans. The name 72T, it sounds a little strange. It's kind of like 401k. All of these come from its section number in the IRS tax code. It's also called a 72T payment plan, 72T distributions, substantially equal periodic payments, or SEPP, and a SEP plan. As I mentioned, it's a clever rule that allows you to plan for early retirement distributions before age 59 and a half without incurring a 10% early withdrawal penalty. Now, the catch with the 72T is that you can't withdraw funds anytime you wish. You've got to commit to a rigid schedule of substantially equal periodic payments, such as monthly, quarterly, or annually. You have to take these distributions for 5 years or until you reach age 59 and a half, whichever is longer. For instance, if you start a 72T at age 50, you'd have to continue retirement distributions for 9.5 years or until you're 59 and a half. But if you start at 55, you'd only have to make distributions for 5 years until you're 60. Now, after that, after the plan expires, you can take retirement distributions any way you like or stop taking them. However, once you reach age 73, or it's going to be 75, starting in 2033, you generally must take annual required minimum distributions, or RMDs, from traditional retirement accounts, whether you used a 72T plan or not. So let me give you a couple more examples of 72T plans. Let's say Adam accumulated a large nest egg in a traditional IRA ahead of schedule and wants to retire early at 45. He could set up a 72T plan that, again, must last for 5 years or until age 59 and a half, whichever is longer. So he'd have to adhere to a 14.5-year schedule of periodic distributions until he reaches age 59 and a half. Another example is Terry, who gets downsized from her job and is offered an early retirement payout at age 54. After she leaves the company, she rolls over her 401k into an IRA and sets up a 72T plan. She must take 72T distributions for 5.5 years until she's 59 and a half. Now, you might be wondering, well, how much can you withdraw under a 72T payment plan? It really depends. The amount of money you can withdraw is calculated using one of 3 IRS-approved accounting methods. One of these methods provides variable distribution, so they're going to change year to year, while the other 2 methods require fixed withdrawals. So all of these are going to use factors like your age, your account beneficiary's age, your account balance at the end of the prior year, and your life expectancy factors, which are published in IRS tables. So I'll briefly go through the 3 accounting methods you can use. So the first is required minimum distribution, or RMD method. With this, you simply divide your account balance at the end of each year by your life expectancy factor. Again, this is something the IRS publishes. You've got to recalculate the payment annually with your new account balance and a new factor because now you're a year older. Therefore, if your investment value declines, your distributions will decrease. And if your account value goes up, your distributions increase. So this method, again, this is the one that's variable, and it's the best when you only need to tap a small amount from your retirement account annually, as it's going to calculate the lowest annual withdrawal compared to the other methods. So the second method is called the fixed amortization method. With this, you're going to use a fixed interest rate, and it's currently up to 5%. To calculate a yearly distribution that would spend down your account balance over your life expectancy. The dollar amount remains the same each year, so you're going to withdraw the exact same amount annually, and it's typically the second highest calculation, so the middle of the 3. And it kind of works like a mortgage amortization schedule, but in reverse with the payments made to you. And the third method is called the fixed annuitization method. With this, you divide your account balance by an annuity factor, again derived from IRS mortality tables, and an interest rate. As with the fixed amortization method, the distribution amount remains constant for the duration of the 72T plan. However, it's going to produce the highest calculation of all 3 methods. Therefore, it's best when you need to maximize account distributions. There is a special rule that applies to the 2 fixed methods that will protect you if your account value declines, like during a recession. You're allowed to make a one-time switch to the RMD method. Again, that's the variable one, which significantly reduces your required distributions, preventing you from draining your account during a market downturn. However, once you change to an RMD method, you've got to maintain that until your 72T plan ends. All right, now that you know the basics of how a 72T works, let's talk about the pros and cons to consider. I think the primary advantage of using a 72T is that you're spending your retirement nest egg without having to pay a hefty 10% penalty before the age of 59 and a half. Whether you're facing a financial hardship or maybe you're just fortunate enough to retire early, you can use a 72T to pay down debt or even supplement your income. You might think of a 72T as an income bridge if you retire before being eligible for a workplace pension or Social Security retirement benefits. The downside is that breaking the strict 72T rules means you would owe the 10% penalty retroactively, plus interest on all your withdrawals that you made prior to age 59 and a half. Some mistakes that void the plan include not taking a timely distribution and taking too little or too much from your account. Another con of a 72T is that once you begin a plan, you can't contribute to that account or even add new rollover funds until the plan ends. However, there is a way to prevent this by splitting your retirement into a dedicated IRA that's solely for your payment calculation instead of using your entire nest egg for a 72T. For example, let's say you have $1 million, but you only need an annual payment of $20,000 a year. You could split off $400,000 of your million into a separate IRA and only run the 72T on that account. A split strategy allows you to tap or make contributions to a different retirement account without voiding your 72T plan benefits. So is a 72T payment plan a good idea? Well, if your retirement nest egg is large enough to tap early without jeopardizing your financial future, setting up a 72T can be a great money move. For instance, you might have many years to go before turning 59 and a half and have no other source of income like a taxable brokerage account to pull from. Note that if you have a significant Roth retirement account balance, you can withdraw your original contributions penalty-free. However, distributions of Roth account earnings before the age of 59 and a half would be subject to ordinary income tax plus that additional 10% penalty if you're, again, younger than 59 and a half. You can also set up a 72T to avoid that early withdrawal penalty on a Roth account. To sum up, a 72T is a terrific way to avoid an early withdrawal penalty from a traditional or Roth retirement account when you absolutely need the funds, and you can execute the plan properly. Just be sure you can afford to trade a portion of your nest egg for an immediate cash flow. However, if you, your accountant, or a financial advisor don't administer a 72T correctly, it becomes void, and that can cost you a significant amount of penalties and interest. Therefore, I recommend getting help from a tax pro like a CPA who can help you set up a 72T based on your financial goals and avoid any expensive mistakes. If you have questions about a 72T plan or tapping your retirement account early, I'd love to hear from you. Again, you can contact me at lauradadams.com. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast. We've got a great team working on the show. I want to thank Steve Rickyberg, who is our audio engineer. Holly Hutchins is our director of podcast. Morgan Christensen is our advertising operations specialist. Rebecca Sebastian is our marketing and publicity manager. And Nathaniel Hoops is our marketing contractor.